Welcome to JT Capital Group's webcast. This is an in-depth exploration of the real estate landscape following a challenging 2023. The past year was marked by steep interest rate hikes, an increase in supply, and growing expenses, significantly impacting our industry. Our discussion today will analyze these effects, provide an outlook for 2024, and explore market opportunities and strategic responses. Joining me today is Denver Lobo, our managing principal of our capital markets team, and moderating our discussion today will be Deepa Kula, who's our managing principal of the investor relations team. Let's begin this engaging conversation. Deepa, if you would.
Perfect. Thank you, Sapin.
Sure.
So we'll just jump straight into it. Many significant factors contributed to the market landscape in 2023, and one of the biggest ones was the interest rate. Would you say we are in a new norm of higher for longer?
Yeah, great question. Well, I'll start with 2023. As we've seen, 2023 was marked by the Fed's maintaining a higher interest rate regimen, right? Largely counteract inflationary pressures, and this largely made sense as it led to more of a cautious approach, right, impacting everything from borrowing costs to different investment strategies. However, as we're looking into 2024, there's definitely a shift on the horizon. According to recent signals we've seen from the Fed, especially towards the tail end of 2023, and comments right from the Fed Chair Jerome Powell, we're potentially moving towards a period where we might see a reduction in interest rates. This pivot's primarily influenced by the evolving economic landscape, notably decrease in inflation rates. I know we're waiting on some additional reports coming out today, tomorrow, that have come out and will hit. For the commercial real estate sector, this potential shift in monetary policy could signal a change in market dynamics. Lower interest rates could lead to more favorable borrowing conditions, potentially increasing investment activities and project financing. We've seen construction costs increase or balloon significantly where we're just not seeing the funding available for that. However, it's important for us to recognize that these projections are not set in stone. And we'll get into it a bit more today, but they're definitely contingent on ongoing economic data, the Fed's assessment of the broader economic health. So as such, right, our strategy should be flexible going into 2024, certainly responsive to these potential shifts. By no means, as I was mentioning, they're not in stone, and we're probably a bit more conservative than maybe the market's overall market sentiment is in terms of probably the amount that we're going to see potentially the rate cuts. I'd say in conclusion, while we've been navigating a period of higher for longer interest rates, 2024 might usher in a more accommodative monetary environment.
Perfect. Thank you. And what are the implications of these higher interest rates for multifamily assets?
Yeah, so short answer is I'd say we expect transaction volume to increase from last year. Not necessarily return to, I'd say, prior to 2023 norms, but we're definitely expecting transaction volume to increase from last year, especially for capital looking to be placed in that gap funding slice, if you will, of the capital stack, whether it's mezzanine, pref equity, or private credit. Largely, there's still a big bid ask price in the market. And for equity to participate, we're really thinking that there's just going to be a higher demand in terms of higher return because of that cost of capital presently is a lot higher. We expect that to continue until we start to see the borrowing costs come down for those lower yield transactions. In the market right now, we have a strategic income fund, which really is a special purpose fund that we're looking to place in selective opportunities, especially those that have to reconcile, let's say, their balance sheet against assets that required pre-2023 or after 2020 or after 2019, with some sort of floating rate and or a combination with a expiring rate cap. This generally is driven by maturing loans or rate cap expiration or the need for liquidity or forced asset sale. So that's what we're seeing in terms of implications for multifamily.
Thank you. Denver, do you think there's a disconnect between the interest rates and the property valuations right now?
Yeah, that's a good question. And, it's something someone just touched upon right now. I believe that there is a disconnect between interest rates and property valuations, and the missing link is transaction volume. The drop in multifamily transaction volume has been significant. After a record high of almost 230 billion in 2021, 200 billion in 2022, and as of November 2023, that number stood at 60 billion. That marks almost a 70% year-over-year drop, which is significant. And thinking about the main reasons for this, we were just at the IMN conference in Laguna last week. It didn't seem like the access to financing was the main reason for this. It was really the impact of interest rates and pricing uncertainty for buyers and sellers. They both agreed that property values were down, but they didn't agree by how much. And so that's kind of one of the pieces that was really focused on at the conference, saying who's here to step into the void that's been left by these local regional banks, because your large money center banks are also limiting their commercial property exposure at the behest of regulators and have less free capital since many of their loans have already been extended rather than getting paid off. Many regional and commercial banks, the ones that I was just mentioning, are cutting back on mortgages because they're already at an outsized exposure to commercial properties. There was a stat late last year saying regional banks have almost 70% exposure on their own balance sheets on average to commercial real estate, which is extremely high.
Right.
As Sapan was talking about, extremely excited for the fund that we're working on at JT Capital, which is the Strategic Income Fund. Us, alongside with other private equity shops, have raised tens of billions of dollars for debt funds that are willing to deploy at times like this when the banking industry is stressed. And we are taking a larger market share at the expense of those banks. And so, we're extremely optimistic for 2024.
Perfect. And continuing the conversation about the regional banks and how exposed they are to commercial real estate, how do you think their exposure to CRE is going to unfold? How are they going to try to work it out with the sponsors? Consolidations, loan sales, what do you think?
Yeah, it's been a rough year for regional banks. Public perception is at pretty much all-time lows at the start of 2023, right? You're thinking of extremely great banks like SVB, First Republic, and their involvement within real estate within just about 6 months or so just all about disappeared. Typically, these banks lend anywhere from 30 to 45% of the debt on commercial real estate per year. In 2023, that value of new originated loans was down 76%. So you can see that they're under stress. It's not only what they have on their books, but also the public perception of it. And then new regulations that have also come up, such as Basel III Endgame, are going to increase the amount of capital that banks need to hold, further increasing the cost of capital. It's going to be a hard environment for banks. And so, if they're not participating, it kind of leaves a void for private equity companies like ours that sort of have a foresight for not only, the next 6 months, but really 3 or 4 years out of how to kind of gain a market share in this space. And so, in 2024, I think there'll be a decent amount of consolidation. There will be loan sales. At the conference last week, we were just talking about how we haven't seen a lot of those come out onto the market yet, and similar with other private equity companies as well, which means that these regional banks and some of the large commercial banks are holding it on their balance sheet. And at some point, something's got to give. You got to mark it down. And so again, in 2024, other capital providers such as insurance companies, private equity, private capital will kind of come in to fill that void.
Got it. And with the constraints in capital markets being so tight and the capital being expensive, and the transaction volume being so down, how are you accounting for the lack of comps and visibility in cap rates?
Yeah, it's such a great question, and uh, one of the anecdotes is someone was telling us they were trying to bid for a property, and they put in for about 5.75 cap rate bid in there. They had about 9 or 10 other buyers looking for this property. Ultimately, the property traded to a 1031 exchange buyer at 4.5 cap. Is 4.5 cap the market? Is 5.75 the market? It's extremely divergent. And in the second half of 2023, appraisal values have had the largest dispersion we have ever seen. And the reason is they are also trying to be a little bit wary of where things are, and that's because of the transaction volume being down. And so um, at JT, we tried to take not only like a cap rate and go into a sensitivity analysis on cap rates and kind of go out of about it from that standpoint, but we look at other metrics as well, like price per pound, that have kind of become more the standard right now, just because you can't really trust the cap rate that we're seeing across markets. And so that's how I kind of see it evolving over time.
Agreed, agreed. And thank you for that because, you know, 1031 capital, they have to place it somewhere and, they're willing to go for a lower cap rate. And is that the norm? And if that's the only available capital, it's very divergent. Thank you for that. And, moving on to the outlook for 2024 and talking about the fundamentals, do you expect market fundamentals to shift severely in multifamily over the next 6 to 12 months?
Yeah, let's just put the supply aside for a moment. We know the supply has been one of the larger contributors to the softening of the rental market. Particularly in the Sun Belt region, right? I think there's about 15 markets, large markets are making up about 89% of that. But that aside, we expect the fundamentals remain strong in the markets we're looking at. We just expect more of a normalization while in the markets we're looking at, and while viewing the pretty much the last 10, 15 years more or less as an anomaly. um, when we look at the data near term, past the current all-time high in terms of multi-family construction starts, right? Just referring back to that supply pipeline, we're still about at 750,000 units below normal vacancy levels. I think the exact number is 760 or 769,000, and we're expecting that number to be a growing shortage at least through 2028. So as we get the pipeline in terms of constructions dwindles kind of back down to an asymptotic zero in some of the markets we're at, we expect absorption really to account for that, the new deliveries through 2025, even part of 2026, and reestablish that equilibrium in terms of that shortage that we're seeing. And then, therefore, as an outcome from that, where the rental market will see some growth, and that growth will reflect more of a normalization, 4% or so. Also, look, we're not any better than most folks at predicting the interest rate environment. Our view is that rates won't be cut as aggressively as the market appears to be calculating or indicating. I think late December, we saw the 10-year drop below 4. I think it got down to around 371, 375 bips. That's about 70% priced in, with largely expecting a March rate cut, which no longer looks like a viable rate cut. I think the latest probability is south of 50%. We're taking more of a traditional approach to this. We're fixing our baseline against current yield curves. We're not underwriting deals to any rate cuts at all. And so we're pricing and modeling based on as if rates are going to remain where they're at today, and we're taking that into account.
Right, thank you. I mean, that's the most conservative way to do it. And, just expanding on what you just said, Sapan,
Mhm.
the migration to Sunbelt, at least in the past few years, it has been steady. And Sunbelt is really growth friendly. and relatively still affordable. And the weather is great. So we continue to expect that there's going to be migration to the Sun Belt. And we also hear questions about, what's the impact of single family homes on the rental market and for the apartments. And I recall reading an article on Wall Street Journal saying that there's never been a worse time to buy instead of rent because it's 52% more expensive to buy a home right now because of the interest rates. And also, there's limited supply. Um, the home prices are high, and with the higher interest rates, if ourselves, if I'm going to sell a house, I still need a place to live. I need to still buy. So no one's wanting to sell their houses unless they really are in a position where they really have to. So it's not a demand problem. It's oversupply problem for at least for multifamily.
Well, you can
And
always stay at one of the JT Capital Class A apartment units.
thanks. Thank you, Denver. It's always an option. Yeah. You guys, moving on to, the financing void, one of the biggest puzzles for acquisition is the debt structure. And who do you think will step in to fill in the shoes of the void that's left by the regional banks?
Yeah, it's a good question. I touched upon a few earlier, but at this conference, we were talking to bridge lenders, the large money center banks, life insurance companies, other private equity companies like ours with either private preferred equity or debt funds. So, ultimately, my takeaway from that was the money is out there, but it's more expensive and offered with less leverage. That's kind of the summary of everything. So for bridge lenders, they were saying they're still funding stuff anywhere from the 55 to 70% LTV, but they need to know on the back end, how are you going to finance your loan eventually? Because if an operator comes to them and say, we just need a bridge loan until we get a 3.5 loan from Freddie or Fannie, you're gonna be like, that's not realistic in this market. We've shifted into this new norm that we're talking about. And you have to kind of be looking at 5.5, 6 in your underwriting to just make sure that that deal's good and solid for your investors. The large money center banks I've been kind of impressed with. They are playing more offense. They are marking down their books. They are provisioning for higher loan losses, and that's the start. Like that's where you start, so that you can start making new loans. Because otherwise, you're just going to be trapped. And they don't have a similar public perception problem than the regional banks do. The other large players are life insurance companies. Typically, they are smaller players in this space. However, they've gotten much larger over the last year. As an anecdote, one of the life insurance companies there was saying we were active and we doubled our allocation to commercial real estate in 2023. Almost about 150 basis points over SOFR. However, you can't get the leverage with some of the life insurance companies that you're looking for. Historically, short-term fixed rate products, life insurance are excellent sources of capital for, and that was about 10 to 15% of the market. In 2023, that jumped to about 25% of the market. So they're definitely there. They're definitely active in that short-term space. And then it's private capital. There's a lot of dry powder out there that kind of everyone's talking about. However, in 2023, that dry powder was all about non-existent. Everyone was questioning as to when that will deploy. And then Q4 rolled around, and it was either because of the sharp decrease in interest rates from about October to December, or the fact that they just have to deploy some of this capital. Otherwise, their own LPs are going to be asking where are the returns for all this money that you've called. So that's a theme that I think we'll see a lot more of private capital kind of coming back into the market and providing some of this capital to investors. And so yeah, the money's out there. You gotta work hard to find it. It's a little bit more expensive, and but ultimately buying assets with these tougher underwriting guidelines means that we'll be better off in 25, 26 when you really get a chance to hold these properties.
Right. And with all this turmoil in the market, there's always opportunities out there. And with everything that's happened in 2023, if we look ahead, what are the opportunities in 2024? The biggest opportunities for multifamily this year?
Yeah,
Someone, you want to take that?
absolutely. So I think
Thank you.
the opportunities we're probably looking at least from the JT fund, is already we've shifted over from acquiring assets on a one-off. We've gone down that path of diversify, kind of have a basket of assets invested in, and we'll talk a little bit about that strategy. But I think the opportunities for most folks that have that capital, that dry powder sitting on the sidelines, is looking for what I'm just going to call distress, right? Because operationally, the asset may not be distressed, but it's facing distress from external factors. I alluded to earlier folks that had bought, pre 2023, in terms of that balance sheet reset, to today's pricing. Um, they may have to refinance. They could have an expiring rate cap. There's a cost to that. They may have spent a considerable amount of their budget, if they didn't have the right rate cap in place, towards meeting their floating rate interest needs, and so there may be a shortage there in the renos. There may have been a need for liquidity by a partner, so it could have been that there's a forced sale, whether it was due to a loan maturity, or maybe the loan extension test didn't meet the needs, and therefore there's a cash in refinance. And again, maybe it doesn't model out for them at that point, and it's bringing it back to the market. So really, those are the opportunities where, and as Denver, shared with us, that funding gap, where we can come in, at least with this fund, fall in that 60 70 percent gap, LTV gap, where we can get, mid to upper teens returns in a shorter period of time, if not even higher, um, while not having the same risk that we may not necessarily have, especially given the current price dislocation we're seeing in terms of where is the true price, right? We talked about cap rates being all over the place, in terms of, are we at the mid fives? Are we at six? Are we doing an assumable? Could it potentially be a sub five? Again, it just depends on where you're at. And then we haven't talked about negative leverage. I think any new debt right now could potentially put you in that situation. A lot of private lending, with the mid teens, low teens interest rate. You're looking at taking on negative leverage, so that may not make sense, right, in the short term for your asset, because really you're banking on cap rates coming down or compressing, in that situation. So, which we wouldn't want to put ourselves into that position. So yeah, in terms of opportunities, we're really looking at that laser focused, where there's a lot of upside. You can get disproportionate share of the equity, in deals where you're essentially resetting that cost basis. Kind of going back to rebalancing that balance sheet to today's pricing, to today's lending rates. And I liken it to looking at an investment maybe 3 years ago or 4 years ago even, and saying, I like this deal. I'll come back to you 3 years from now or 4 years from now, make a decision, and then basically coming in at a discount to par value on that same deal. So that's how we're looking at the opportunities, versus buying single assets. We're just not seeing the pricing there that we'd feel comfortable with, short of that distress, which it seems like a lot of the dry powder would be, and is anticipated competing against. But rather, this niche opportunity that we see has similar upside potential, better diversification, and significantly lower risk exposure.
Right, right. Thanks, Evan. And the way I see it, the opportunity is twofold, right? There are too many good deals that are operationally very efficient that are in distress because of its capital structure and need a little bit of cash infusion. And that cash is rare to come by right now, the infusion. So we have opportunities from both directions. We have good deals, and if we have the capital to deploy, it's a good problem to have, having too many good deals. And with that, are there any geographical markets in which you see or expect the most opportunistic deals?
It's a loaded question. I think it depends on your investment strategy. What you're ultimately seeking. I think you can make an argument to Florida having significant opportunity, largely because of the rise in the insurance costs, and there's a whole different discussion around that. But I think that the opportunities on that may possibly be on some of the fixed rate pre 2019 good cost basis, where you can potentially get deploy capital into those deals, or there may be like what I was alluding to, just previously, where folks are either being dragged out to market, and there may be, they're great deals, operationally sound, and they just have external factors that could be impacting it. And I think, just looking at deals that can go from floating to fixed, long term fixed. Those are the deals you feel comfortable with, and then of course, insurance is something that you'd have to get comfortable around. There's no denying that we're through the or out of the woods yet, at least related to the insurance exposure. Not just Florida, but just nationally. There's a number of markets impacted by that. We're seeing Texas, where we're seeing that there's an impact there. Even all the way out here in California, right? We're seeing major carriers leaving, the state, which is causing, partially why some of the rates have been increasing. And we're looking at deals in markets we feel comfortable in. We're looking even up in the Northeast. We're looking at deals up in New York. We're looking in Georgia. We're looking at some stuff in the Carolinas, and really each market's got, in general, certain nuances specific to the market. But overall, there's just a lot of deals that we've been saying no to or passing on. The market's kind of affording us the ability to really be picky, and I think that's really how we're looking at it.
Got it, got it. And you're talking about the bridge loans,
Mhm.
and with a lot of loans that will be coming up for maturing, um, you guys think that are we heading towards a recession with this huge volume of loans that are coming up for maturing in the coming year?
Oh boy, I don't want to take that one. I'll take a stab at this, but no crystal ball here. I mean, there's $620 billion worth of CMBS loans coming due in 10 years. 20% of that's coming due next year. Well, we're here already, 2024. It's one of those sayings where it's like, if you owe the bank $100, the bank has a problem. If you owe them $100 million, the bank has a problem, right? And so we really see this as a banking problem rather than a real estate specific kind of problem. Overall, from our kind of calculations and then reports we've seen elsewhere as well, average commercial real estate prices are down about 20%. And that's across the spectrum, very large market. That's 20% lower from where they were in 2021. We think this might be one of the best opportunities to buy very high quality assets that we couldn't get our hands on in 2021, 2022. There are many deals that haven't shifted lower, and that's the one Sapan was talking about. We're seeing deals as well that they're coming at the same or higher level with the same NOI as 21, and that just doesn't make sense. There's been a massive rate shift, and we need to kind of see that in the pricing to kind of get really excited about single assets. On the fund side, use of proceeds like the funding gap that Sapan mentioned, that's 21 billion right now, supposed to extend to about 44 billion in 2026. Who's going to be there? Who is going to be, financing that funding gap? Our fund, other private equity funds are minuscule compared to that size. And so, as Sapan said, we can be very picky and choosy, not only on the asset, but the operator too. We want to work with high quality institutional operators that need this, that are doing this, that have a brand image to maintain, so that we're working with them, hopefully not only in the next 5 years with this fund, but well beyond that as well. We kind of try to think about this in decades rather than year to year.
Right, right. And when the economy runs hot, when the capital is relatively inexpensive, when the SOFR was like 0.25, everybody wants to pay more, and none of the deals were penciling out in 2021. And right now, the market definitely has given us an opportunity to really be picky about the projects that we infuse capital into. So, with this large amount of loan that's coming up for maturing, what do you think are some of the solutions that sponsors can, implement with the banks? How can they work this out?
Yeah, yeah, that's a
Yeah,
go ahead, Denver.
is that something you can go for it? Yeah.
Yeah, I was just saying, I think this has been probably discussed. Definitely at the conference. We've had similar conversations with several other sponsors. Probably the biggest thing of advice I can give anyone is start talking early. Especially with your lender, make sure you have a relationship with them. Don't wait until the last minute. I mean, communications. I can't stress or emphasize the importance behind that. Especially if you're aware that you've got this expiring rate cap or maturity on your note, or it doesn't pass that test on the which likely wouldn't, I'd imagine, if you bought in 2023, 2022 on a floating for that extension. But start that conversation early, and see how you can either restructure or navigate through some challenges that you're likely facing with your senior lender, or if you have a pref equity partner in the deal, start that conversation as well. And then also same thing with your LPs. Especially if you're looking at a potential cash in situation, you want to make sure you've got that equity lined up. And so sometimes the hardest conversations have to be had early on, not last minute, not 3 months prior to that terminal point. That said, one thing I did want to mention is that today's conditions, right, they're notably better than they were, the last two, I'd say, challenging market cycles we had, right? And we're going back for you history buffs, early 90s, like 1992, 93, or the Great Recession, 2009 and 10. Today's fundamentals, I did want to bring that up, really. We're being challenged by the office space, not so much multifamily. And also during that period, we saw NOI taking a big dip. We saw rents were collapsing, and then we saw occupancy, across different property sectors diminishing. We're not seeing that today. We're seeing a softening in rent, but we're still seeing strong fundamentals. We're still seeing good occupancy. We're seeing challenges for first-time home buyers and just home buyers in general. So we're really in a good environment in terms of fundamentals, and in terms of kind of exposure. It's really on that office side. I think multifamily isn't a great place for some of that reset, but then accessing or getting into some of these deals where the way we're looking at it is the it's probably just a capital market turbulent period where you can gain outsized returns in a much shorter period of time, um, than you would if you were in a traditional 7 to 10 year hold.
Got it. Right. And with all of this opportunity coming up,
Mhm.
how does the origination of mezzanine debt, pref equity, and the bridge loans, how does that look for the capital stack?
I believe that the next 12 to 36 months are going to see the largest transaction volumes in this part of the capital stack than we've ever seen before. Hence, the thinking and the thesis of getting this fund started early, when other private equity groups are just kind of starting to think about this idea. We're deploying capital. Um, and the speed and magnitude of interest rate increases was kind of what got us to this point. Even some of the best operators out there require either time or additional capital to get to the finish line, and that's what we want to give them. Um, and someone was mentioning extending loans. There's also workouts going on. I think that's going to be a big space in the banking sector. If you're a young gun on this call, you might as well get involved with investment banking in that space, because that's going to be a very large space for the next 3 to 5 years to really figure out how groups can get access to this capital and manage it safely. Someone mentioned GFC. From period of 2008 to 2012, we really saw a retractment in prices of single family, right? Like everyone remembers, some of these houses were 20K, 30K. We have never seen such a large shift in multifamily in a decade. And so again, we're excited about the opportunity to get involved with some of the single asset side as well at the right price. If commercial real estate is down 20%, as someone mentioned, office is actually taking a large part of that. But there are deals to be found, and we're very excited for the next 12 to 36 months, and I think it's going to be sort of a golden era for investments into this part of the capital stack.
Thank you. Thank you for drawing that conclusion and similarity about how the single family homes took a hit, in the Great Recession in 2008 and 2009, and how the multifamily space is actually going through that galvanization process right now. And, I want to focus the last 10 minutes of our webcast on the JT strategy in 2024. I know we peppered in the strategy here and there, but, how has our real estate investment strategy changed, if at all, in 2024? And how are we thinking about portfolio diversification from a risk management standpoint?
Yeah, I'll jump in. And you're right. Yeah, we've peppered in quite a bit of that strategy throughout. I think the biggest thing is we're going through the route of the fund. One, we want to achieve diversification. Two, we're seeing significant opportunity to get disproportionate equity share across great deals. As Denver mentioned, there's deals that we may not necessarily have seen come out to market, or may have just been held for a longer period of time. We're getting access to that. We get in at a better cost basis, almost like a reset in some cases, and enjoying that upside. I think the capital markets turmoil is going to open up a significant opportunity for that. Largely, unless we're able to get into a position where we can acquire a direct asset sale, the fund route is one of the best ways to get access to a number of deals rapidly, and also combined with the fact that there's a significant shortage in the funding, right, in that capital stack that we're targeting. We strongly feel we found a niche opportunity where we're essentially deploying capital just below institutional and large private equity thresholds. We're not seeing a whole lot of dry capital competing against our money. We've been having these discussions with potential uh, borrower sponsors that we would like to deploy into for a number of months now. We've ideally identified are groups that are actively looking into refinancing. They're well capitalized, well financed, have a solid track record. Where we would be a small slice in terms of our exposure. For example, we may deploy capital, and it accounts for maybe 10% of the overall equity based on today's pricing. So if we were to reprice the deal today, we can get equity that would be significantly higher than that percentage. And to us, that looks like an opportunity to get that outsized return. Make sure we've got adequate downside protection in place. Our focus is more on the downside and principal protection, and less so on that upside. We feel like we're already gaining some of that upside just by getting a better cost basis, and then getting a disproportionate share of the equity. Denver, if you want to jump in on any of that as well, I know you and I have had a number of discussions where we've enjoyed actually just studying the market and seeing where some of these entry points could be with less competition.
Yeah, I think we've said it in different words along the call, but what we're looking for in this fund is distress in the capital stack, not distress in the business plan. We're looking for the business plan to work swimmingly. Some of these operators have 95% occupancy. They can push rents, but these assets are operationally efficient. They're institutional grade assets. So you're getting almost, as you said, you're getting 3 years ago pricing at today's value, which is like about 20% of a discount, and for very high quality assets. So risk to reward, I think this is one of the best opportunities out there, and that's what makes us so excited because I talked to a lot of investors who say, well, there's a 16% pref, and I say, well, what's in it? And they're like, some kind of cryptocurrency, different coins are in there. I'm like, well, yeah, like, risk to return, that's probably horrible return for you. Just making sure that you're kind of looking into what assets we're putting into the fund is super important for our LPs as well. Really get a sense of how high quality these assets are. So that's the only thing I'd say.
No, thank you. With the market the way it has been, it's always good to concentrate on protecting the downside. And if we buy right and the price is right, we are automatically getting an upside because of the risk-adjusted return that we're going to get on these assets. And this is the last question because we're almost at time. And either one of you can take it. And is there a difference in investment criteria for JT for us purchasing a single asset versus for the fund itself?
I'll let Denver take this one.
Yeah, I'm happy to go into it. It's just a different amount of deployment of capital. The asset and the asset quality, the location quality is exactly the same. For the single asset multifamily side, typically deploy of a total capitalization of about 30 to 90. So we typically deploy anywhere from 10 to $40 million. Good locations, we're looking to do anywhere from like 60 to 70% LTV. It's not over leveraged. And for the fund side, what we're looking at is, as Sapan said, kind of the smaller portion that institutional funds that are too large aren't playing in. So anywhere from 2 to 7 million is kind of the sweet spot of the fund to provide anywhere from mezz debt to pref equity and everything in between to really work with this operator to see how we can help them get to the finish line. And the finish line is typically sale about 12 to 24 months down the line. And in terms of the metrics we're looking at, y'all both touched upon, looking for not only population growth, but also good jobs, wage growth. We're looking to see all of those statistics, and we work with CoStar on that, get large data sets, which we actually go through and do scenario analysis on to come up with the locations and straight down to the street level that we want to be involved in. And the prior deals that we've already done and exited help us kind of get that data advantage over other groups that are participating in those areas, because we know those markets like the back of our hand, and we hope to kind of build on that momentum.
Perfect. Thanks, Denver. Over to you, Sapan.
All right. Yeah. Thanks, Deepa. With that, I just want to thank everyone for joining us today's insightful discussion on real estate market challenges and opportunities in the wake of 2023 and our outlook on 2024. We hope the perspective shared by Denver and the thought-provoking questions moderated by Deepa today will provide you a deeper understanding of the current market dynamics and our strategic approach here at JT Capital. For further information, please feel free to reach out to us or contact us. We appreciate your participation and look forward to continuing these valuable conversations in our future webcasts. Thank you and have a great day.